In Chapter 9, we're going to talk about receivables. Now, how many of you guys remember from Principles 1 what type of an account is a receivable? It's an asset. Receivables are an asset. And what is a receivable? What is accounts receivable? Money that is owed to us, to the company. Correct. So, basically, when we're dealing with receivables, in a perfect world, everybody pays us. But you know and I know that's not the way it works. And so we have to keep track, while we're showing the receivables on our books, we also need to be realistic with those receivables that might not be collected. And that's what this chapter is going to talk about, is how we account for those receivables that aren't going to be collectible. Because of the fact, the longer a receivable is outstanding, the tougher it's going to be collected. So we're going to talk about receivables, and we're going to talk about a method called the Allowance Method for valuing receivables. Valuing receivables mean that instead of just recording the total amount that should be on our books for what we want to collect, we're going to look at historically the percent of receivables that haven't been collected in the past and keep an allowance, so we're accurately showing the books the way they should be. And we're going to look at that allowance method, review some calculations, and then talk about ways that companies may finance their receivables. Receivables are an asset. They're monies that should be collected within the current accounting cycle. Sometimes people need that cash earlier than later, and so they can sell those receivables to a company for a certain percent on the dollar and get that money sooner than later. Accrual accounting. Now, we have talked about accrual accounting in this class many times. What is accrual accounting? I don't necessarily need a definition, but can you guys give me some comments of commonalities of what accrual accounting is versus cash basis accounting? Accrual accounting, isn't that when we show our revenues not when we receive the money for them, but when we earned them? And we show our expenses not when we paid them, but when they were incurred? Remember? Because we want to match the revenues we earn in a current cycle with the expenses that have been incurred to make those revenues. So accrual accounting records transactions in the period in which they occur rather than in the periods in which cash is received or cash is paid. That's the cash basis. We're dealing with the accrual basis in accounting. Just because we believe it's more realistic to the operations of a business. Then valuation is where we assign values, money values, to business transactions and the resulting assets and the liabilities. Valuation is when we go for our business and we purchase supplies of $200, but we got a deal on them and they really should be $400, but we paid $200. What are we going to value those supplies on our system? $200, because that's our cost in those supplies. So valuation is how we determine what we're going to assign the value. Next, we've got disclosures. In our accounting records are the financial statements that we present to the end user. We are required to present any type of notes to the financial statements to help those users fully understand how we record various transactions. So in the previous chapter, we talked about LIFO, last in, first out for inventory. We talked about FIFO, first in, first out, or the average method. We have to disclose in our financial statements how we value various business transactions. We'll also need to talk about how we account for those receivables that we don't think we're going to be collecting. Now, accounts receivable are short-term financial assets that arise from sales on credit. Sometimes people call them trade credit. I'm used to calling them accounts receivable, where we sell a product or a service to a client or a customer, and they don't pay us right away when they receive it. We grant them credit to pay us within a period of time. Remember, we talked about 210 net 30, which means if they pay within 10 days, they get a 2% discount. Otherwise, they need to pay their whole bill within 30 days. In a perfect world, that would be awesome if they do that, but it doesn't always work that way. In setting credit terms, companies have to keep in mind the credit terms of its competitors and the needs of its customers. So many times in the real world, because other competitors do not require cash immediately, you're going to be not real competitive if you grant different types of credit terms. So you want to be viable or competitive and get the business, but you also need to find that balance of not being so lax on your credit terms that you don't get paid. I know in my profession as a CPA, there are many accountants out there that will extend credit to waiting for clients to pay their bill. We don't do that. We've been burned one too many times. So the way we look at it is, instead of upping everybody else's rates for those people who don't pay, they don't get their tax return, or we don't e-file it until the payment comes in. That way we can keep our prices lower, and those that don't pay don't come to us. Does that make sense? That's just the way we work, and it doesn't seem to hurt us from a competitive standpoint. It's just really frustrating that a few people end up hurting everybody for us. But not every company is able to do that. Companies that are too lenient in granting credit run into debt difficulties because they're not going to get paid. Here is an example or a slide that shows various sectors of the different types of economies, and based on that, the total assets for various companies. So as you see here, with service industries such as advertising and airline industry, the accounts receivable for their total assets in advertising industries are 20% of their total assets. That's pretty significant. In the airline industry, the accounts receivable to their total assets are only 4%. Now, if you think about that, advertising agencies, I'm not saying they don't have assets, but since it's a service and a skill, while they might have computers, really a lot of what they have is intellectual property, intellectual in people skills. Air transportation is heavy in assets. Think of the millions of dollars those airplanes cost. And so, because the airline industry is very heavy in assets, their percent of their accounts receivable to their total assets are at 4%. Doesn't mean that people still don't owe them money. It's just they have a lot of long-term assets, fixed assets. Then as you look at the clothing and grocery stores, which we call merchandising companies, because they purchase goods for resale. They don't create their goods, they just purchase them and resell them. The clothing and grocery stores average about 8% of their accounts receivable are tied into their total assets. Then, when we go up to industrial machinery and computer and equipment manufacturing, where we're dealing with the manufacturing industry, it's up from 15% and 9% of their total assets are linked to accounts receivable. So accounts receivable is worth discussing because it is involved in most of the companies, with advertising being one of the largest. The accounts of customers who cannot or sometimes will not pay are called uncollectible accounts, or we call them bad debt. There are two methods that we account for these bad debts. One is called the direct charge-off method, where we take a loss when we determine this particular account we're no longer going to get paid for. The problem with the bad debt method, or the charge-off method, is it's not in accordance with the accrual method, because we only record it once we know we're not going to get paid for it. So the allowance method is more in line with accrual accounting and GAAP. Notes receivable are short-term assets supported by written agreements called promissory notes. I think we talked about this, or barely talked about it in the prior couple weeks, where oftentimes when someone has an accounts receivable outstanding but they are not able to pay, the employer or the company will sometimes turn it into a notes receivable that gives them a little bit longer period of time to pay their bill. And these notes receivable are still short-term assets, but there's a promissory note attached to this note receivable that spells out the interest rate and the timing of when this note is going to come due. It's generally a little longer than accounts receivable, but it is held by a promissory note or a loan agreement. Promissory notes are unconditional promises to pay a certain sum of money either on demand or at a future date. So it's just spelled out. It's giving them a little bit longer period of time in order to pay, come up with the money to pay. The person or entity that signs the note and promises to pay it is called the maker of the note. And the entity to whom they need to pay the money is called the payee of the note. So here you see a promissory note. It has the amount. It has when the interest starts. I promise to pay to the order of the payee the amount of money. You see, it's just like a check in that it is, the amount is written out and the amount is also spelled out. So the 1,000 is written in numerical form, and it's also written in longhand. The interest period begins on a certain date, or excuse me, ends on the certain date, and it should also state the interest rate that is being paid on the note. The maker's required to sign it. The payee isn't required to sign it. The maker is. So as we start talking about this allowance method, this method, or this process that we're going to talk about, requires losses from bad debts to be matched with the revenue they help produce. So if you think about it, the whole accrual method is set up so we match our revenues with our expenses in the period in which we earned them. If you take it a little step further, the allowance method is really trying to determine, out of these earnings that we've made this year or in this period, how much of these earnings are going to be bad, because we don't want to overstate our income, because we know based on historical understanding that a certain amount of our income isn't going to be collectible. So that's why we want to match those bad debts we know we're going to get with the income we earned during the time. It serves to value our accounts receivable on the balance sheet. We don't want to overstate our accounts receivable. We want to value them with what we actually think we're going to collect with them with. So we're going to offset or create this allowance so we make sure our accounts receivable is in line with what we truly believe we're going to get. Since management can't identify at the time of sale which customers will not pay or how much the company is going to lose, losses from these uncollectible accounts have to be estimated. Now, we estimate them pretty good, but we still don't know. We don't have a crystal ball, so we're going to have to come up with some type of estimate, usually based on historical data. So let's look at this example here. Mandy Sales Company made most of its sales on credit during its first year of operation in 2014. At the end of the year, the accounts receivable, the balance, amounted to $200,000. On December 31st, management reviewed the collectible status of the accounts receivable, and approximately $12,000 of that $200,000 were estimated to be uncollectible. So sitting on the books is $200,000, but we know management feels pretty certain $12,000 of it isn't going to happen. We're not going to get the money. So we're going to create a journal entry to record what we estimate to be the uncollectible accounts. What we're going to do in creating this adjusting journal entry is we're going to increase an account called the uncollectible account expense, and we're going to increase a new account that we are now going to address called the allowance for uncollectible accounts. So as you see here, $12,000 management estimates isn't going to get collected. So we are going to, in our assets, reduce or credit. It's kind of like a contra account, like we've been dealing with assets and accumulated depreciation. This is going to be similar, that we have an asset called accounts receivable, but we're creating an account called allowance for uncollectible accounts. So we're going to debit our expense, increase our expense for $12,000. So we can write off in the current period the expenses associated with those revenues we earned. We're also going to credit this allowance for uncollectible accounts, so we record the estimated uncollectible accounts for the year. Any questions on that so far, guys? Does that make sense? This transaction is applicable to the accrual method of accounting, where we're matching revenues with expenses, in that the uncollectible accounts expense gets used to value accounts receivable at the amount that it's expected to be collected. So we are kind of, in a way, writing down our accounts receivable, and we're recording an expense so we can offset those revenues with those expenses in that current period. A payee on the promissory note, which is the company, includes all the promissory notes it holds that are due in less than 1 year as a note receivable in the current assets section of the balance sheet. We know that current assets are assets that can be converted into cash within the current operating cycle. What are some current assets we've talked about? Cash, of course, is cash. What else have we talked about? Current assets. Accounts receivable. The notes receivable we know that we're going to collect within the year. How about inventory? Didn't we talk that inventory is also a current asset? Because we hope to get rid of that inventory within the current year, don't we? Don't we? Any interest that gets accrued on these notes receivable is also included in the current asset section called interest receivable. we're going to be accruing interest along with that note. So that interest earned, or that interest income, is going to be credited to income, and the debit is going to be interest receivable. And we anticipate we're going to receive it. If we're going to receive the note in the current year, we're going to also receive that interest in the current operating cycle. Uncollectible accounts expense appears on the income statement as an operating expense, right? Okay. So, excuse me, I'm trying to make this a little bigger. This one still has Windows 8 on it, which I hate. Okay. So, we talked a little bit about disclosures, notes that we have to disclose in the financial statements. Allowance for uncollectible accounts appears on the balance sheet as a contra account, similar to accumulated depreciation. How remember we show all the assets in the cost, and then we show in a contra account all the accumulated depreciation we've taken against those assets. So ultimately we see the net figure on the financial statements, but we keep them separate so we know what we bought them for and what we've taken in depreciation. The same is true here for our allowance of uncollectibles. We will keep our accounts receivable at their full amount, and our allowance for uncollectibles is going to be a contra account, so the net amount is really the accurate value of our accounts receivable. Here you see the current asset section of a balance sheet. You see here we've got our cash, our short-term investments, our notes receivable, and then you see our accounts receivable. There's accounts receivable, and then there also shows less allowance for uncollectible accounts. So we net it. We take the 200 minus the 12, or the 188, and we show that net amount on our balance sheet. Then we've got our interest receivable from the note and our inventory. So let's look at this, see if we can kind of figure out the answers here. We're going to match these concepts with the statements. The four concepts are valuation, accrual accounting, periodicity, and disclosure. Who wants to take number 1? Come on. Preparing an adjusting entry to record the estimated uncollectible account expense. What concept are we dealing with here? I'm sorry, what? B, accrual accounting is perfect. Yes, we want to match any expenses in the same period where we earn the income, don't we? Right? Next, subtracting the allowance for uncollectible accounts from accounts receivable. By doing that, what are we trying to accurately show on our balance sheet? The true valuation, right, of what it's really worth. Number 3, preparing an adjusting entry to record interest earned on notes receivable. Periodicity, don't we want to show the interest earned in the period in which we earn that money? We want to record that interest in the period in which we really are earning it. Reporting the net realizable value of receivables on the balance sheet. Oh, I was wrong. 3 is B, accrual accounting. There is no C. I was trying to find a C to match. Accrual accounting is matching the income in the period with the note receivable. Reporting the net realizable value of receivables on the balance sheet. It's saying disclosure. Separating accounts receivable from receivables from employees. We want to disclose specifically what receivables are from whom. So now we're going to look to figure out how we estimate our uncollectible accounts receivable. There's a couple ways we can do it. One way is using a percent of net sales. One way is to use something called the accounts receivable aging method. So the longer accounts receivable are sitting out there, the longer we know those aren't going to be any good. Then we're going to write off the uncollectible accounts and make some calculations related to notes receivable. Again, allowance account is important because we don't know in this period what's not going to be collected, but we need to record something in this period to offset the revenues with the appropriate expenses. So the accountant of the company makes an estimate, usually based on past experience and current economic conditions. The estimated losses from uncollectible accounts need to be realistic. Generally speaking, companies are going to want to overstate assets, overstate income, understate expenses. But we want to be conservative in our approach and realistically portray the real company's financial condition. So we're going to look at doing the percent of net sales method and the accounts receivable aging method. So this percent of net sales method is the amount of this year's net sales that aren't going to get collected. The answer determines the amount of uncollectible accounts expense for the year. So as you see here, the following balances represent Varda Company's ending figures for the end of the year. They show that the sales are $322,500. There were sales discounts of $2,500 taken. $20,000 of the sales got returned back to the company. And we have sitting in the allowance for uncollectible accounts a $1,800 credit here. Okay? The following are Varda's actual losses from uncollectible accounts for the past 3 years. So in 2011, they had net sales of $260,000 and $5,100 in losses of uncollectible accounts. So if we take the $5,100 divided by our $260, we've got a percent of 1.96%. In 2012, our income jumped up, but our uncollectibles jumped up too, to 2.34%. In 2013, our income went down just a little, but boy, we got a handle on our uncollectibles. It went back down to 1.69, the lowest it's ever been. So we're going to take an average of it all. We're adding our total sales for 3 years. We're adding our total losses from the uncollectible accounts for 3 years. And we're dividing it. The $17,000 divided by the $850 gives us a 2% uncollectible, or losses from uncollectibles. Does that make sense how we're doing that? Very logical. So Varda's management believes its uncollectible accounts will continue to average about 2% of net sales. The uncollectible account expense for the year 2014 is going to be 2% of the gross sales minus the sales that were returned, minus our sales discounts. Do you see? Because the gross sales included everything. We keep track of what's getting returned and what our discounts are. So 2% of $300,000 means we anticipate our uncollectibles to be $6,000 based on the income we made in this period. Does that make sense? So what we're going to do, the journal entry that we are going to record is to show an increase in our expense and an increase in our allowance for uncollectibles. So we're going to debit our uncollectible account expense for $6,000, and we're going to credit what we call that contra account, the allowance for uncollectible accounts of $6,000. And our note there is to record uncollectible account expense at 2% of the net sales. This application of doing the accrual accounting leaves the allowance for uncollectible accounts with a balance of $7,800. Now the reason it's a balance of $7,800, remember we started the period with $1,800 here? So by adding an extra $6,000, we now are going to have $7,800 sitting in our balance. The balance consists of the $6,000 estimated uncollectibles and the $1,800 balance estimated uncollectible account receivables from previous years. Now let's do a problem like this, okay? I don't know why my computer's stuck. There. I hate Windows 8. Excuse me, guys, reader. Do you want to save it? Refresh. Sorry. Okay. Come on, there it goes. Course Smart. What page is here? I got a book right here. So we will start with let's start with SE2. There. So SE2 basically states on page 356 that during the first year of operation in 2014, Brown Sales Corporation made most of its sales on credit. At the end of the year, accounts receivable amounted to $199,000. On September 31st, 2014, management reviewed the collectible status of the accounts receivable. Approximately $16,500 of the $199,000 of accounts receivable were estimated to be uncollectible. What journal entry are we going to make? Any thoughts? So we're going to debit an expense and we're going to credit a contra account, right? So the first thing we're going to do is make this bigger so you guys can see it. First, uncollectible accounts expense. So we're going to have this December 31st, uncollectible accounts expense for how much? $16,500. And what's our credit? Any ideas? We're doing that contra account. That contra account is allowance for uncollectible accounts. Perfect. Allowance for our uncollectible accounts is going to be $16,500 also. So our uncollectible account expense shows up on our income statement as an expense. Our allowance for uncollectible accounts is going to offset our accounts receivable. So we find a real true value of our accounts receivable. Our explanation here is going to be to record the estimated uncollectible accounts expense for the year. Okay? Everyone got that so far? Let's look now at the next one. The next one, SE3, says, at the end of October, Santa Fe Company's management estimates the uncollectible accounts expense to be 1% of net sales of $1,385,000. Prepare the journal entry to record the uncollectible accounts expense, assuming the allowance for uncollectible accounts has a debit balance of $7,000. So what they're telling us right here is we anticipate 1% of the net sales to be uncollectible. What would we show? They're giving us information we really don't need. It doesn't matter that the allowance for the uncollectible accounts right now has a debit of $7,000. That doesn't matter. We have to record the journal entry to show 1% of our sales is not going to be collectible. How are we going to do that? 1% of $1,385,000 is what? $13,850. So December 31st, I'm going to just copy and paste this. Okay? But this is $13,850, right? $13,850. To record estimated uncollectible account expense for the year, and what we'll do is we'll show how we're calculating it. 1% of sales. Okay? Does that make sense, guys? How y'all doing? Okay. Let's do another one. Let's do E2A. Okay? E2A shows us at the end of the year, Bertha Enterprises estimates the uncollectible accounts expense to be 0.7% of net sales of $15,150,000. The current credit balance of the allowance for uncollectible accounts is $25,800. Prepare the entry to record the uncollectible account expense. What is the balance of the uncollectible allowance for uncollectible accounts after this adjustment? So what we're going to do here is let's first record the journal entry for E2A. What are we going to do here? Same accounts. Okay? But instead of 1% of sales, isn't it what is it, 0.6? 0.7% of sales, okay? Then, so what was this amount now going to be? $106,050? $106,050. Right? Got it? Now, let's create a T account and figure out in our allowance for uncollectibles allowance for uncollectible account, what did it tell us was the balance before this journal entry? $25,800. It had a credit balance of $25,800. So if it has a credit balance here of $25,800 and this journal entry we just did is going to show a credit of $106,050, what is our new balance sitting in our allowance for uncollectibles after this journal entry? $131,850. That's where that number comes into play. If it gives us that information, it's always adjusting. It's an accounts receivable, it's an asset, and it doesn't wipe out like our income statement accounts do. This continues to be ongoing. $131,850 is now our new balance sitting in that account. Okay? Okay. Now, let's go back to the PowerPoint. The next method we're going to look at is called the aging method. This aging method is a little different. Maybe just a titch more complicated. This is the basis for the aging receivable method is the amount of the ending balance of accounts receivable that we know is not going to get collected. The ending balance of allowance for uncollectible accounts is determined directly through an analysis of our accounts receivable. The difference between this amount and the actual balance of the allowance for uncollectible accounts is the expense for the period. So basically the way we handle this aging method is we look at all the accounts receivable and we know we have an allowance sitting there in our allowance for doubtful accounts. So we're going to look at how much of these accounts receivable do we think aren't going to get collected, and we need to create a new balance for allowance for doubtful accounts. That difference is what we're going to expense for the current period. This has got a little extra twist in it than the percent of sales method. The aging of accounts receivable is a process of listing each customer's receivable account according to the due date of the account. If the account is past due, chances are it might not get collected. That possibility increases as the account extends further beyond the due date. So let's look at Radco Company. What we're going to do here, Radco has various customers, and we have a total of $88,000 sitting in accounts receivable. Two of the clients or customers, T-Or for $1,800 and some others for $42,000. The $43,800 isn't even due yet, so we're sitting okay with those. The 1 to 30 days past due is $28,500. From 31 to 60 days past due, we're dealing with $8,400. From 61 to 90 days past due, we're dealing with $4,900. And those that are over 90 days past due, we're dealing with $3,200. Now the company has determined, management has determined, that those accounts that are over 90 days past due, it's a 50% likelihood we're not going to get that money. So 50% of these accounts receivable that are 90 days and over, we're not going to get. From 61 to 90 days past due, management tells us 30% of these we're not going to get. 31 to 60 days past due, 10%. 1 to 30 days past due, 2%. And not yet due, 1%. So management's going to give us those figures. We don't calculate that. Management's going to tell us, historically, this is how it works. So what we're going to do is, based on those totals in these various columns, we're going to take over 90 days the 3,200, 50% of it is 1,600. From those 61 to 90, 30% of that is 1,470. From those 31 to 60, 10% is $840. 1 to 30 days, 2% is $570. And not yet due, 1% of that, $438. So if we add up the $438 and the $570 and the $840, $1,470 and the $1,600, we've got about exactly $4,918 that we should show as our balance in the allowance for doubtful accounts. This should be our balance that we have determined should be sitting in there. Once the target balance for the allowance for uncollectible accounts has been determined, the amount of the adjustment depends on the current balance sitting in that allowance for doubtful accounts. We will assume two cases for the balance of RADCO's allowance for uncollectibles. First one, we're going to say, prior to determining this, that RADCO has a credit balance of $1,600. Then we're going to do a scenario where they have a debit balance of $1,600. So in doing this aging method, what we're doing is we have determined, based on these percentages, that the balance of the allowance should be $4,918. Now, if prior to doing this exercise, there is a credit balance of $1,600 sitting in their allowance already, we're going to want to create an adjustment for the difference to come up with the $4,918. So in that first scenario, where they're telling us there's a credit balance of $1,600, but we want the balance to be $4,918, we need to then make an adjustment of $3,318 so we can bring the balance in the allowance account up to $4,918. So in order to do that, we will create a debit to the uncollectible account expense of $3,318 because we want it to show $4,918. Since $1,600 is already sitting in there, we're going to do the difference to create a new balance of $4,918. We're going to debit our uncollectible account expense, credit our allowance to bring the allowance for uncollectible accounts to our level of estimated losses. Okay, here's a second scenario. Now, instead of a credit balance of $1,600, this tells us we have a debit balance sitting in our account of $1,600. A debit balance. We want it to be a credit of $4,918, but previous to this exercise, we know we've got a debit balance. So in order to create, for $4,918, so in order to create a credit of $4,918, we're going to have to do a journal entry that shows an uncollectible account expense to be $6,518 and to credit our allowance for uncollectibles of $6,518. You see here, we had a debit balance of $1,600. But if we want a credit balance of $49.18, we're going to have to credit this account $65.18 to get that. Does that make sense, guys? If we've got a debit of $1,600, but we ultimately want the credit to be $49.18, in order to get a credit of $49.18, we're going to have to credit $65.18 because we're going to subtract $65.18 minus our debit of $1,600 would give us a balance of $49.18. Does that make sense?
Is it normally a credit?
It's normally a credit balance. But in this case, if it's a debit balance, in order to get our credit balance up to $49.18, we're going to have to credit this for the $49.18 plus the $1,600 in order to get our balance where we want it to be. Okay? So, both this method and the percentage of sales method estimate the uncollectible account expense, but they do it in different ways. One just takes a percent of net sales and goes with it. The other one is really scrutinizing the accounts receivable and really picking them apart to see what's going to be collected, what's not. The percent of net sales method is what we call the income statement approach, and the accounts receivable method, the aging, is the balance sheet approach. So we know the income statement method takes our sales, our net, on our income statement, and comes up with a percent. The aging method of accounts receivable takes our accounts receivables, breaks them out by their aging, and applies a percentage of it to determine what should be in our allowance account. Now, what I want to do, let's go back to the book. Let's do a couple of these problems, okay? Y'all cool with that? Let's take SE4. Okay? SE4 basically tells us an aging analysis on June 30th of the accounts receivable of UZ Door Corporation indicates that uncollectible accounts amount to $86,000. Prepare the journal entry to record uncollectible account expense under each of the following independent assumptions. So it's under this method, it's telling us what it should be. The uncollectible account should be at $86,000. Okay? That's what it's telling us. So what we're going to do here under SE4 is if our uncollectible should be $86,000, we need it to be at $86,000. That's what we want it to be. But prior to this, what did it tell us it was at? It told us it had a debit balance. Allowance for uncollectibles has a credit balance of $18,000 before the adjustment. So if this is at $18,000, but we want it to be at $86,000, what is it we need to do? We're going to credit, but what are we going to credit? We're going to credit this 86 minus what's already sitting in here of 18, or 68,000 to get there. So we will do on June 30th an uncollectible accounts expense for $68,000, and we'll do allowance for uncollectible accounts for $68,000. Because we want it to be at 86, but to get it at 86, that's the adjustment we need to make, is for 68. Does that make sense, guys? Under this method, it gives us what the ending number should be, so we have to force it to work. Under the other method, it just tells us this is what we're going to claim for our sales. Remember, the difference is, under this method, under the aging method, we don't just have these accounts receivable sitting in the current period. We might have them from the previous year also. So we are always updating it. Now, let's go back and see our next example. Allowance for uncollectible accounts has a debit balance of $14,000 before the adjustment. So instead of this being 18 credit, it's a $14,000 debit. What is it we need to do in order to get this to end up with an $86,000 credit? Don't we need to take this plus this, or we're going to have to create a journal entry for $100,000 in order to end up with an $86,000 credit? Does that make sense? How you guys doing? Let's look at E3A. E3A tells us Security Service Company's accounts receivable account shows a debit balance of $104,000 at the end of the year. The accounts receivable debit balance is $104,000. An aging analysis of the individual accounts indicates estimated uncollectible accounts to be $6,700. Prepare the journal entry to record the uncollectible account expense under each of the following independent assumptions. The allowance for the uncollectible accounts has a credit balance of $800 before the adjustment, and the allowance for uncollectibles has a debit balance of $800 before the adjustment. So we want it to end up at $6,700 here. That's what we want it to be. It's telling us it has a credit balance of $800. What is it we're going to need to do to adjust this so we end up with $6,700? What will be our debit to uncollectible account expense, and what will be our credit to allowance for uncollectibles? I'm sorry?
5,900.
Perfect. 5,900. 5,900, if we do a journal entry for 5,900, do you see the 800 plus the 5,900 will give us our balance we want of 6,700? Does that make sense? Now let's take it, and instead of it starting out with a credit balance of $800, now it has a debit balance of $800. What now do we need to do? What adjustment do we need to have to end up with a credit balance of $6,700? $7,500. How many agree? No? Yes. So, if we have our $7,500 minus our $800, gives us our $6,700. How are you guys doing? Making sense? Now let's look at E4A. Okay? If I go too fast, tell me to slow down. At the beginning of 2014, the balances for accounts receivable and allowances for uncollectible accounts were $215,000 and a credit of $15,000 respectively. So let me just make this happen. Okay? Accounts receivable was how much? Accounts receivable was $215,000 and the allowance was $15,700. $215,000 and this one was $15,700. Okay? Okay? During the year, credit sales were $1,600,000 and collections on accounts were $1,475,000. In addition, $17,500 in uncollectible accounts was written off. Using T accounts, determine the year-end balances of accounts receivable and allowance for uncollectible accounts. Then prepare the year-end adjusting entry to record the uncollectible account expense under each of the following conditions. Also show the year-end balance sheet presentation of accounts receivable and allowance for doubtful accounts. Management estimates the percent of uncollectible credit sales to be 1.2% of total credit sales. So, we know our credit sales were $1,600,000, right? So, if we figure it out using this method A, if the accounts receivable balance started at $215,000, is that right? It started at $215,000. What were our credit sales during the year? $1,600,000. Okay? And then what did it say it collected during the year? 1,475,000. Right? And how much was written off during the year? $17,500 was written off during the year. So what would our new balance in accounts receivable be? We would have this. We would add our debits, subtract our credits. Should our new balance in our accounts receivable account be $322,500? All I did here was add my debits, subtract my credits to come up with this new balance of $322,500. Okay? Now, it's telling us that based on a percent of sales, what is the amount of uncollectible? Based on the percent of sales, it tells us management estimates the percent of uncollectible credit sales to be 1.2% of total credit sales. What are our total credit sales? 1,600,000. 1.2% of 1,600,000 is what? Is what? 1.2% is 19,200. It's okay. It's another zero. So we know using this net sales method, percent of sales, that we are going to do an entry, uncollectible account expense of 19,200, and our credit for allowance of uncollectible is 19,200. If we started the year with 15,700 in our uncollectible, right? And it told us we ended up writing off 17,500. Yeah, we ended up writing off 17,500 of our uncollectibles. Then, because this, when we wrote it off, our accounts receivable, we had to credit that, we debit our allowance. Then we now are going to credit 19,200. Our new balance here is going to be 17,400, right? No. Our balance was at 15,700. And then we wrote off 17,500. Allowance for uncollectible accounts. So we had a balance sitting in here, prior to this new one, we had a balance sitting in here of $1,800 prior to doing our adjustment here, okay? $1,800 was our balance prior to this. So in doing this journal entry, in doing this 19,200, we are going to credit 19,200, okay, to this account. So our 19,200 credit ends up giving us a new balance of what? $17,400. after this journal entry. Okay? Now, how is this going to look on our balance sheet? Let's just kind of do a little mini balance sheet. We'll have accounts receivable of $322,500, and then we will have less our allowance for uncollectibles of $17,400, gives us our net accounts receivable of $305,100. Does that make sense? Kind of? How are you guys doing? Now let's take it and use the other method. Okay? Now the other method, probably I can keep all this on here, but the other method goes back and tells us, based on an aging of accounts receivable, management estimates the end of year uncollectible accounts receivable to be $19,350. So we want this figure to be $19,350. That's where the difference is. Okay? It's telling us what they want it to be. If they want that to be $19,350, then what are we going to do in order to get that amount? We started the period with $15,700 here. We wrote off $17,500. So we have right now, prior to this $19,350, we have a debit balance of $1,800, don't we? What is it we need to do? What journal entry do we need to do to end up with a balance of $19,350? Isn't it $21,150? If we have $1,800 as our balance right now, and we want to end up with a balance of $19,350, don't we need to credit this $21,150 in order to get there? Does that make sense? If this is our balance, $1,800 debit, but we ultimately want to get to $19,350 credit balance, we're going to need to credit this allowance for uncollectibles $21,150 in order to end up with a credit balance of $19,350. Okay? Does that make sense? Remember, under the aging receivables, it tells us what it needs to be. That's what the ending balance is going to be. So, in this scenario, our accounts receivable is going to still be, it started with, the balance was $215. We had collections of $1,475,000. We had credit sales of $1,600,000. We wrote off $17,500. So we've still got the same net balance here. of 322.5. So we're going to show our accounts receivable 322.5 less allowance for uncollectibles of 19,350 is going to give us our net of 303,150. Under the other method, it was at 305,100. Okay? Hang in there. We're going to go through many problems like this, okay? Okay? Now, let's look at
Yeah, I don't understand. You don't have to do anything with the 17,500 and 15,700.
that was,
To you, I don't understand.
they gave it to us so we could come up with a balance. So they purposely gave us that information. At the beginning of 2014, the balance for accounts receivable and allowance for uncollectible accounts were 215 and 15.7. So they're telling us that's what they were at the beginning of the year. So what I did is I put in the 215 and the 15.7.
And that's where we got the 1,800 from. I got it now. Okay.
Okay.
I was just confused with those two numbers in the beginning. That's why I couldn't come up with the 2,150. That's the whole.
And then from there it said during the year, credit sales were 1,600,000. So what I did is I went in and put in 1,600,000 credit sales. Credit sales meaning accounts receivable. And then it said collections on those accounts were 1,475,000. Once we collect the money, we credit it. 1,475,000. Then it told us, in addition, 17,500 in uncollectible accounts were written off. So since we knew we weren't going to get them, we credited 17,500 to come up with our accounts receivable balance of 322.5. Does that make sense? Now, under here, we had started our credit of 15.7. When we went and wrote off 17,500 in accounts receivable, if we credit something, we have to debit something else. Okay? Once we write them off by crediting accounts receivable, we then have to debit our allowance for doubtful accounts. This is because, remember, this initial journal entry shows our uncollectible account expense. That's when we write off the expense and we credit our allowance. So when we finally really do write off accounts and we zero out that accounts receivable, we're going to use our allowance for uncollectibles to offset it with, since we've already done the expense in that period. Okay? Make sense, guys? Let's look at E5A. Okay? E5A, then we'll take a break. During 2014, DeLuca Company had net sales of $5,700,000. Most of the sales were on credit. At the end of 2014, the balance of accounts receivable was $700,000, and the allowance for uncollectible accounts had a debit balance of $24,000. So I'm going to go in here, I'm going to create some T accounts, okay? This is called allowance for uncollectible. Okay? Our accounts receivable had a debit balance of $700,000, and our uncollectible account allowance was a debit of $24,000. $724,000. So $700 is our accounts receivable, and our allowance had a debit of $24,000. See what I'm doing? I'm just putting it in there. Then it tells us, DeLuca's management uses two methods of estimating uncollectible accounts expense: the percentage of net sales method and the accounts receivable aging method. The percentage of uncollectible sales is 1.5% of net sales, and based on an aging of accounts receivable, the end-of-year uncollectible accounts total $70,000. So it's telling us DeLuca's management uses two methods: the percentage of net sales method and the accounts receivable aging method. The percentage of uncollectible sales is 1.5% of net sales, and based on the aging of accounts receivable, the end-of-year uncollectible accounts total $70,000. Prepare the year-end adjusting entry to record the uncollectible account expense under each method. What will the balance of allowance for uncollectible accounts be after each adjustment? Why are the results different? Which method is likely to be more reliable, and why? So if we do it under the percentage of net sales method, then 1.5% of net sales. What are the net sales? $5,700,000. What is 1.5% of $5,700,000? $1.5% of $5,700,000. Yes, $85,500. So we're going to do a journal entry. Uncollectible account expense of $85,500. And then we'll do our allowance for uncollectible, $85,500. Okay? This is under the net sales method. What would be, if we put this $85,500 as a credit up here, what is our new balance in our uncollectibles here? Won't we? Credits minus our debit. Wouldn't our new balance that way be $61,500? Right? If we then go and do it the other way, so what I'm going to do here, I'm going to keep that so we can compare the two. Okay? So if we do it the other way, it goes and tells us one method is the 1.5% of sales, and based on an aging of accounts receivable, the end-of-year uncollectible accounts total $70,000. So they're telling us that our allowance for uncollectibles in this respect need to be $70,000. What journal entry do we need to create to get $70,000 under the aging method? Wouldn't we need to make a journal entry, uncollectible accounts expense for $94,000 and an allowance for uncollectibles of $94,000 to get our $70,000 credit? Does that make sense? So we would want it in this case $94,000, $94,000 in order to end up with our $70,000 credit balance. Which one of these do you think is more reliable? Do you care? The more reliable one tends to be this aging method. This net sales method